Hi everyone, hope everyone's doing fine. This is my end of the day review of the 31 of July 2026. Just a heads up, this is the DAX, of course, as you can see in the screen. I've been only trading for 2 years now, so this might be a little rough for someone. And I'm Portuguese, so my fluent language is not English. Yeah, I think I'll do my best and I'll try to improve as my experience grows and my trading gets better. And I will only do until 1 the end of the day review. So in the higher time frame in the daily chart, the market is in a broad channel where both bulls and bears can make money. Bears can make money selling below bars, and bulls can make money buying above bars. It's a sloped trading range. For today, there were bulls trapped above the 3 of July and bears trapped above the 29 and probably above the 23 of July that never got a chance to get out, break even. In the 5-minute chart, assume that the blue lines are higher time frame. In the 5-minute chart, bar 1 was a bear reversal bar. It broke above a bull channel line, which might be reversing on the next few bars, as Dr. Al says. However, you have to be mindful that this bull channel is very big in terms of number of bars. So the bars here to here are at least 60 bars. This increases the chance that in the higher time frame, this is also a bull channel, and in the higher time frame, it needs also to reverse on the next few bars. So I can check the 30 minutes, or I'll check the 30 minutes to see what I'm saying. Basically, you see this is a bull channel line, and the market broke above it, and it might reverse on the next 5 bars. I think it's 5 bars, I'm not sure. So in this case, this is six 5-minute chart bars. So you have to be mindful of that, the correlation of the bull channel number of bars with the higher time frames. So bar one, bear reversal bar. I think it's okay to sell below it, betting on a failed breakout above a bull channel line. However, bulls with bar 2 were able to not trigger that signal and created a very strong bull breakout bar. This bar trapped traders above bar 1. Okay, bar 3, is a confirmation of the breakout. It's not a bear bar, which is the minimum that bulls needed for the confirmation. If you see carefully, bears who bought, I'll put this here. Bears who were trapped here and sold more here were able to get out at the average. Even if they have this entry, they were able to get out at the average. However, not in the actual zero loss on the first entry. Okay, bar 4, good for the bulls, strong bull bar. Only can buy here because you have to be mindful of the trader equation. If you sell here, where is your stop? If you sell here, where is your stop? Where's your target? Selling here might require a very wide stop, and you don't have probability. It's probably 30%, 40%, so you need to get at least 2 to 1 or 3 to 1 to be profitable. So not ideal, or not possible to sell here because of this. Okay, so bar 4, bull breakout bar. Bar 5 the same. This is another pause. Bar 6, it's the third leg on a climatic wedge top. So you have 1 pause, 2 pause, 3 up. So you can sell the bar 7, which is bear bar closing near the lows. It's low probability, but look at the reward. If you put stop here, probably best here. This is where daily bulls were trapped. I can write it down. Daily trapped bulls on the, I don't know, I think it's 29. I don't record. So basically, if you sell below bar 7 and use a stop above this line or above the high of the day and targeting the low of the day, it's very big reward, low probability and low risk, but very big reward. So comparing to this, it's make it different because you know probability, you know reward, you know risk, you know the tree, so you can make a profitable trader's equation. Okay, so bar 8, good for the bears, not ideal. Better if it was a bear bar closing on its lows. This might be the tails, and this might indicate trading range price action. So follow through is important. So bar 9, high 1, a signal bar, probably more bears above it because there are trap traders above bar 6 and at the close. So they got out with bar 8, but let's assume bar 6 high not get tested yet, and traders who bought that hoping for higher prices are not trapped, and they might get out break even if it reaches there. Okay, so bar 10, low 2 short or second entry short, sorry. The same applies. Higher probability of this because it's second entry, but stop loss needs to be up here, above, at least above the high of the day. Okay, so bar 11. Bar 11, it's a weak bear bar. More buyers below bar 9. Bar 12, as I said before, bull use bar 12 to get out of the bulls use bar 12 to get out of longs that they were trapped. Not ideal to buy below, but not ideal to sell because it's a bull bar. Okay, so bar 13, bear breakout bar, breaking below bar 12. You can say it's a third push-up, 1, 2, 3, but it's really not important that. Okay, so this is now a bull flag probably because it's going sideways and not probing down, but the next bar is important. Okay, so bar 14, breaking below the bull flag. The follow through is important to confirm as it was on bar 3. Bar 15, bull breakout bar, bull trend bar, not breakout. This is a failed breakout below the bull channel, close to the EMA. I think it's okay to buy. Bar 16, bulls are trying to continue the trend up, but if you buy above bar 16, you have low probability because most breakouts fail, and you need at least stop loss below bar 15, which indicates that the breakout needs to happen, so it's low probability and high risk. This means that if you sell here, put a stop here, have high probability. If you go for a 1-to-1, it's a good risk to reward and good probability, so positive trader's equation. Okay, so bar 17, double top signal, After two strong bull bars, better to wait for second entry. Bar 18 is the same as bar 1 and bar 2 and 3, sorry. If you are trapped, sell more, get out at the average of the entries. If you are trapped, sell more, get out of the average of the entries. It's the same concept. However, bulls are not able to break above the high of the day yet. Bar 19 is the doji. This is a OII pattern, so it's breakout mode. Better if you wait for a breakout of this pattern, for higher probability, above or below. Okay, for example, bar 20. Bar 20 is a bear breakout, good for the bears. It's probably going to get to bar 14 where bears are trapped. Good for the bears, not ideal, but good enough. Bar 21 is a doji bar, the minimum that bears need to confirm the breakout. Bar 22, outside bar, tight trading range. It's a barbed wire, more or less, as bar 23 is the same. Bar 24 tried to break above bar 21, 22, and 23 highs, but it failed. So it's a kind of a double top. Bar 25, good for the bears. However, this is now the third leg down. If you count 1, pull back, 2, pull back, 3. So 1, 2, 3. It's a wedge. Has, you could say, yeah, it has gap opens. Bar 19 low was not tested by bar 24 high, which opened a measuring gap probably. However, if you sell bar 25, you are selling the third leg on the first test of the EMA. Not ideal, but not okay to buy neither. Better to wait for higher probability. Okay, bar 26, okay for the bears, not ideal. Bar 27, bull breakout bar, breaking up far above bar 26. This makes bar 26 a bad signal bar and it might get tested. Would you buy above bar 27? I wouldn't, because bull, the bear channel line was not yet broken and you would be buying at the top of a bear channel. So better to wait for a higher low or some kind of a back test with bar 26. Bar 28, bull bar, good for the bears, good for the bull, sorry. It's testing above bar 24. However, if you put yourself on a bull, on the bull case, imagine you buy here, waiting a breakout. You see bar 25, 26, and you now probably get out break even. So better to wait, and this is tight. So better to wait for a higher low of some kind and another bull bar. Okay, so bar 29, bear bar. After the 3 bull bar microchannel, it's better to wait for higher probability. So probably more bulls below, not right below bar 29, but at the 50%. Okay, so bar 28, 29, 30, the same as bar 1, 2, 3, and bar 16, 17, and 18. There are more cases, like for example, bar 18. If I buy below bar 18, you see this bar, or even the close. You see this bar and you get disappointed, you sell out of longs. So the same here, you buy above bar 28, you see bar 29, you get disappointed, you buy more and sell break even at the average. This bar 31, bear bar, okay, for the bears, not ideal to sell. You're selling at the low of the range, so better to wait. Bar 32, the same, good for the bears, but you are betting on the breakout below bar 26, you're already on a failed double bottom, which is a breakout. It's trend continuation, so you would need a stop loss above my measured move of a 1-to-1, and if you think that the probability is more than 50, let's say 52%, you could go for it. I don't say 51 because of the fees and human errors, but 53, I think it's a good pocket for the mistakes. So now bar 33, bull bar, not ideal to buy above. Buying above a bull bar after a small bull bar after for a bear micro channel, not ideal. Bar 34, the same. Bar 35, it reached 50%. I think it's 50%. You can say this. Yeah, 50% of the bear micro channel, and it's now proving down. It's a low one short signal at the EMA, so good for the bears. I think it's okay to sell, but you need stop loss to be up here because I don't have really much. Here I cannot see. You cannot see it here. I'll see. Okay, so forget it. Basically, this is not a great stop loss location, because there are probably more sellers here. This bar tested the breakout point of this bar, letting bulls get out of longs, but there are still bulls trapped above bars. So here, not a good stop loss placement. Bar 36, good for the bears, follow through. Probably not ideal to sell below because you are selling at the low of the trading range or of a bear channel, which is now more sideways than down. Bar 37, good for the bears. Bulls are unable to make another bars like bar 27 or bar 15 to make a kind of a higher low double top, in this case lower low double bottom, sorry, to make the market go higher. Bar 38, good for the bears, bear trend continuation. Okay, so bar 39, as I said, I like bar 15, weaker than bar 27, but you get the idea. Would you buy above? I wouldn't buy. I would take profits of the bear leg. If you're still short, I would get out here because it's a 1, 2, 3. It's a 1, 2, 3. You can count as many as you want, but it's a wedge. So market can go up at least here. If you count this as 1, 2, 3, the last leg is magnet, so it can go up here. And I'll rather get out of longs, get out of shorts above it. So bar 40, the same thing as bar 28, 29, 30. Trapped, sell more, get out at average. Bar 41 reached the high of bar 34, allowed trapped bulls to get out. It did not break any major higher low, so bear trend still intact. Bar 42 inside bar. Bar 43 outside bar. This is limit order again. Try to break above it. It failed. Break below it. That's the same thing here. It's better if you wait for a breakout of the pattern, because it's higher probability of you betting on the breakout, because this can go on for many bars. So bar 7 breakout, good for the bears. However, there are no trapped traders above, so the market might need to get the retest this price, or a bit lower, but back test. bar 48, good for the bull, confirming the break, good for the bears, confirming the bear breakout. Bar 49, first pullback. It's not good buy above. You're buying at the EMA and buying against two strong bear bars. Better to wait for a second entry or for follow through. Bar 50. Bar 50 is the continuation, second leg continuation of bar 47 and 48. Bar 51, good for the bears, follow through. Bar 52, the same, not a good buy above, very, very low probability, I think 20%, or even, I don't know if it's less, but less than 30% for sure, because you are buying against a tight channel after two strong bear bars at the low, below the EMA. Bar 53, start of the third leg down. Okay, so now this is a wedge. Bar 54 the same, bar 55, 56. If you can see, this is climatic, this is not sustainable. So if you buy, if you get a bull bar, as you get a bear bar here, it's the same, this is not sustainable. You need to get, if you get a bull bar, if you get a bull bar now, you need to, okay, so bar 58, bull bar, you need to at least get out of shorts above it and expect 10 bars, 2 legs up to the EMA. I think it's okay to buy it because you already tested the low of the day, but it's low probability after such a tight channel down. Bar 60, good for the bulls, 3 bull market channel. Bar 61, low one signal or low one follow through. It's low one signal. Not ideal to sell. You are selling where traders are trapped, and it might reverse up and test the EMA. And look where your stop loss might be. As I said here, the third leg on the wedge, it's a magnet. So if you sell here, where's your stop? It's here. It's a magnet. So it's probably the top of a trading range. So it might be here or even here. Very bad risk to reward and not ideal probability. So better to wait for breakouts and follow through. So bar 62, it's the last bar that I review. I review from 8 London time until 1, just to try to review a couple of swings. This is only 2 swings, so hope everything was good. I try to improve on the next few end of the day analysis. Hope this was good, and yeah, see you on the next one.